This stupid simple trading strategy works every single day. No fancy indicators, no complex algorithms, and no guessing games. If you can draw a box, follow a few rules, and wait for confirmation, you'll understand one of the most powerful trading concepts used by the banks, institutions, and professional traders. And that concept is supply and demand. By the end of this video, you'll know exactly how to plot your zones, how to spot the best setups, and what confirmations I use intraday to actually enter the trade with Confluence. So make sure you have a pen and paper and open up your charts, and let's break down the stupid simple system that can completely change how you trade. Before we jump into how to draw boxes and zones, you'll actually need to understand why supply and demand works. Think of supply and demand as footprints of money. Every market moves because of imbalances between buyers and sellers. Supply zones are where institutions sold heavy, leaving pending sell orders behind, and demand zones are where they bought heavily, leaving pending buy orders behind. So when price revisits those areas, what happens? Those leftover orders get triggered and price reacts. That's why you'll often see a big move out of those zones. It's not magic, it's just unfilled institutional orders. And now that you understand the why, let's talk about the how. So now let's get straight into how to actually mark these zones. There's a million different variations online, but this is the simplest way that actually works every day. Step 1 is you want to identify the impulse move. Now, to identify this impulse move, you need to look for a strong impulsive move away from a base. What you need to see is one big candle, whether that be bullish or bearish, which then as a result creates a clear imbalance within the market. And this is where institutions entered their positions. Step number 2 is finding the base candle. The base candle is the consolidation before the big move. It's the area where price paused, accumulated orders, and then exploded away. So what you will see is one small candle in a tight range, followed by a big breakout candle. That is your zone of origin. So now step number 3 is to actually draw the zone. Now you're going to draw your rectangle. You want to mark the entire basing candle from lower wick to upper wick, and I'll show you guys an example here on the chart in a little bit. And then for supply, you're going to find that small basing candle before a large move down. And again, do the same thing. Mark the upper wick to the lower wick of that basing candle. And that is where institutions are going to look for price to return before price makes that reaction and then follows the original trend. So let's go ahead and go on a trading view and mark some of these levels. So now when it comes to a demand zone, what we are looking for is we are looking for one big green candle to the upside, and then next to that big green candle up, we want to see one small red candle. On my trading view chart, the black candles are going to be red candles and the green candles are going to be blue candles. So now we can see that we have this big move up on the Dow Jones futures on the 1 hour time frame. Look, one candle to the left, what do we notice? A small red candle. So as a result, we want to mark this from upper wick to lower wick and project it to the right, and that is then going to become a demand zone. Same thing over here, big move up, small red candle to the left, mark lower wick to upper wick, project it to the right, and that is your demand zone. Going to the daily time frame. We had a demand zone right here. Big move up. Look, one candle to the left, small red candle. Mark lower wick to upper wick. This is your demand zone. We had another one right here. Big move up. Small red candle to the left. Lower wick to upper wick. That is your demand zone. Now, as far as a supply zone, it's going to be the same thing, but flipped upside down. So going to the 3 hour time frame, looking at Friday, we had a very large and aggressive move down. Look, one candle to the left. What do we notice? A small green candle. So as a result, we are going to mark the bottom of that green candle. And because the red candle's wick is higher than the green candle's wick, we're going to mark that as our upper portion of the supply zone. But if price were to trade back up into this area, we would be looking for a reject to take price back down. Same thing right here. Big move down. Look, one candle to the left. We had a small green candle. As a result, this is your supply zone. And again, because the red candle's wick is higher than the green candle's wick, you're going to mark that as the top of your supply zone. Now, if you are taking notes, the one thing I want you guys to make sure that you write down, because this is very important, when we get a supply zone, so let's actually go back over here to this 2 hour one. We have a 2 hour supply zone right here. Again, big move down, small green candle to the left, mark the bottom wick to the upper wick. When price is trading to a supply zone, price is mainly going to react at the bottom of that supply zone, which is going to be the lower wick, and then the open of that green candle, which is going to be right here. Again, through my time trading, this is where we tend to have the highest reaction when coming to a supply zone. Looking at this supply zone over here would be the same thing. Mark the lower wick and then the open of the body. That is typically where we are going to see a reaction. And instead of watching a whole zone for a potential reject, this gives us two exact areas to watch for price to reject off of. Now, as far as a demand zone, you can see big move up, small red candle to the left. Because the green candle's lower wick is lower than the red candle, we're going to mark the demand zone for the bottom of there to the upper wick of that red candle. Now, instead of watching the whole zone, ideally you want to watch the open of that red candle and then the upper wick of that red candle for a potential bounce. Again, there's a very high probability that price is going to react off of those two areas. Instead of watching the whole zone for a bounce, watch that upper wick as well as the open of the body. Same thing over here, nice little demand zone on the 3 hour. Ideally, you want to watch that upper wick right here for a bounce and then the open of that red candle for a bounce. So again, make sure you guys write that down in your notes because that is going to be very, very important. Now, step number 4 is you want to refine the zone. Now, the way that I mark my zones, the time frames that I use, I start on the daily time frame. Again, I'm looking for any basing candles and then a big move up or down to mark my supply and demand zones. After I am done on the daily, I will then break it down to a 4-hour time frame. After that, I'll go to a 3-hour time frame. After that, I'll go to a 2-hour time frame, then a 1 hour, then a 45-minute, and then a 30-minute. So going back to the chart, this is exactly how I would do it. I'll start on my daily time frame. Is there any supply and demand on the S&P futures that I could mark? Maybe we had one right here previously, but we already broke through it, so it's not valid anymore. Once I mark all my zones, I'll go down to a 4-hour. Okay, now we have a 4-hour zone up here. So this is a supply zone that I would watch. Do we have any 4-hour demands? None that spark my interest besides maybe this one right here. It's a little higher risk of an area, especially because the demand zone is so big. But again, ideally, you want to watch that upper wick and then the open of the body. So bam, we have our supply zone and then our demand zone. After I'm done plotting on the 4-hour, let's then go to a 3-hour. So on the 3-hour, we have the same exact supply zone as the 4-hour. So now that's more of a condensed area and higher probability for a reject if price were to come back up here. Boom, I mark all my zones on the 3-hour. Let's then go to the 2-hour. What do we notice on the 2-hour? We have another supply zone within the 4-hour supply zone, which is also a 3-hour supply zone. So we have a lot of supply in this overall area. Again, mark my zones on the 2-hour as well. Once I'm done on the 2-hour, let's go to a 1-hour. Oh my God, what do we notice? We have another zone within those other zones. So again, this is a very high probability area for a potential reject. We have multiple zones lining up at this exact area. After I'm done on the hour, go down to a 45-minute. Mark any supply and demand zones. After that, 30-minute, mark any supply and demand zones. Once I am done plotting on all of those different time frames, I then watch price on a 5-minute time frame and a 2-minute time frame for precision entries. All right, so now you've got your zones plotted. But if you just buy every demand or sell every supply, you're going to get smoked and you're going to lose money. You need confirmation when trading these zones. So let's talk about how I confirm these zones intraday and that a zone is valid and likely to react. So my main confirmation is going to be candlestick reactions. When price enters these zones, whether it be a bounce or a rejection, ideally we would like to see longer wicks showing that price is either going to reject or bounce, engulfing candles showing that buyers or sellers are very strong at the level, or just overall a momentum reversal, also known as absorption, which I actually have a video of absorption. I'm going to leave that down in the description, but that is your first sign that the zone is being respected. Also with the long wicks showing if price is going to bounce or reject. If you see an elevation in the volume, it is very, very, very clear that buyers or sellers are present at that supply or demand level. So that as a result increases the likelihood that price is going to react. Another way that you can look for confirmation is a break of structure. After price taps into your zone, you then want to see a break of structure on your lower time frame. If you're on the 2-minute time frame, that might mean a new higher high after touching demand or a new lower low after touching supply. That confirms that the reaction is legitimate and not just a random wick. And then you could also look for a retest entry. Once structure breaks, wait for the retest back to that area, and that is your sniper entry. You'll often see institutions push away from the zone, trap traders, and then retest quickly before taking off again. That's the move you want to catch. So I actually want to show you guys a trade that I took on Friday where I pretty much shorted the top of the market just by using basic supply and demand. So as we can see on the 30-minute time frame, we have a big move down, a big red candle, and then one small green candle to the left. So as a result, we have a supply zone from this green candle's lower wick, the green candle's open of the body, and then the upper red wick of this red candle. Now, ideally, I'm looking for price to reject off of this green wick candle's low or the open of the body right here. So now if we break it down to a 5-minute time frame, what do we notice happened when we came up into that exact area? Well, price came up first off a weak volume. We had a very strong push into the area, which is what I really like to see. But then we came up to it, we rejected off of the beginning of that zone, and then we came down on this 5-minute candle. It was looking very bearish. The volume started to come in. The volume was increasing higher than the previous volume bars. And overall, it was a pretty bearish candle. And as a result, I went short. I didn't even wait for the full candle to close because it was looking very, very bearish. My entry was at 68.03. And if you don't believe me, I mean, I literally called this out live inside the Discord. NES shorts at 68.03, stop right above 68.07. I was able to capture a 12-point move to the downside. Obviously, I did not know that Trump was going to come out and talk about tariffs and literally tank the market, I think like 170 points. But still, this is proving to you guys that this strategy actually works and I actually use it and I actually make money trading it. Now, this is everything that you want to do. Identify your zones, wait for price to trade to these zones. Look for price to either bounce or reject if you're trading demand or supply. Look for confirmation either on the 5-minute time frame or look for a 2-minute break of structure and even a retest entry with a stop on the opposite side. Now, I always preach that the market trades from one key level of supply and demand to the next level of supply and demand. Ideally, you would look to take price back to the next zone, but sometimes it can be very far away. So typically when I am trading these supply and demand zones, I am bare minimum looking for a 1-to-1 risk to reward, ideally a 1.5 to 2R trade before I start trimming. Once I start trimming, I will then put my stop loss at break even and continue to trim as the trade moves in my favor, move my stop loss more until eventually I'm satisfied with my profits or I'm stopped out in profits. It's very simple, it's effective, and it's repeatable. Now, let's put it all together so you can actually trade this daily. Here is my daily routine. I wake up at 6:45 and go to my monitor. I mark my zones. I note any overnight highs and lows, maybe a Fibonacci retracement, and then I wait for the market to open after marking my key levels. I am then waiting for a 5-minute candle to confirm direction when trading at my supply or demand. And then I will also break it down to a 2-minute time frame to look for a reaction or a break of structure, or even enter on the retest. My stop is always on the opposite side of the candle that confirms my trade. And again, I am bare minimum looking for a 1 to 1.5R trade, ideally a 2R trade. And again, I'm always looking for bare minimum a 1R trade, but ideally like a 1.5 or 2R trade before I start trimming. So now the psychology and patience. Here's the truth, the strategy is simple, but most traders will still mess up. Why? Because they can't wait. They see price near a zone and FOMO in before confirmation, then they get stopped out and blame the system. If you take one thing from this video, let it be this: patience is your edge. Institutions are waiting for liquidity, you should be too. Wait for price to come to you. Wait for confirmation and you'll notice how much cleaner your trades become. So if this video did help you, make sure to smash that like button, but also make sure to click that subscribe button. I live trade here on YouTube pretty much every single day. Other than that, everybody have an amazing rest of your day, and I'll see you guys in the next video.